let's talk about a massive number today, $714 billion. That's how big Canada's pension plan investment fund is. And their latest performance report? Well, it tells two completely different stories. One is a story of incredible success, and the other, well, it's a story of falling short. So how on earth is that possible? Okay, let's get into it and solve this puzzle together. So how can the financial report card for one of the biggest pension funds on the planet look both amazing and, kind of underwhelming at the exact same time? That is the puzzle we are going to piece together. And we're going to use the fund's own data and their own strategy as our guide. First up, the good news. And it is really good news. The fund grew by a whopping 9.3% last year. For a portfolio this huge, that is a gigantic gain in absolute dollars, a clear sign of a really strong year. But, and here's the twist in the story, the fund also underperformed its own benchmark by 1.6%. Now, a benchmark is basically just a yardstick, right? It's the market return. They measure their own active decisions against. So, while they made a ton of money, they actually made less than their own target said they should have. And this brings us right to the heart of the mystery. How can both of these things be true? Was it a strategic mistake? Or is there something much deeper, something way more deliberate going on behind the scenes? Well, to figure that out, we need to look at the rule book they play by. You see, the CPPIB isn't investing for next month or even next year. They're playing a multi-generational game, and their whole strategy is built on a few core, unshakable principles. Understanding this playbook, that's the key to solving our puzzle. And here it is, the three pillars of their philosophy. First, diversification. Pretty simple, right? Don't put all your eggs in one basket. Spread the money out all over the world and across different types of investments. Second, active management. They aren't just passively buying the market. They are actively making specific bets they think will pay off down the road. And third, and this one is absolutely crucial, a long-term horizon. They can ride out pretty much any market storm because they're investing for someone's retirement in 20, 30, even 40 years from now. Okay, so with that playbook in mind, let's go back to that negative 1.6% number. We are now ready to crack this case wide open. And the answer, it turns out, is surprisingly straightforward and totally intentional. And here it is, what I'd call the smoking gun, a direct quote from their own report. They deliberately chose not to be fully invested in the hottest part of the market, which just so happened to be U.S. stocks, and really, a tiny slice of tech giants that had a mind-blowing year. So, the bottom line is, this was a choice. Think of it like this. The U.S. tech market last year was like a sprinter setting a new world record. The CPIB, though, is a marathon runner. Sure, they could have tried to keep up with that sprinter for a little while, but it would have meant totally abandoning their long-term diversified race plan. So they didn't. They chose prudence. They chose the marathon. Now, talk is cheap, right? Let's move on from the theory to the hard evidence. You can actually see this cautious, deliberate strategy reflected in where they moved their money over the last year. Just look at these shifts. You can see them pulling back from things like private equity and corporate credit. And at the same time, check out that big 3% move into safer government bonds. For a fund of this scale, that is a classic de-risking move. It's all about prioritizing stability. This chart just makes it pop, doesn't it? That 3% jump in government bonds, that's a major strategic tilt for a fund this size. They're deliberately adding an anchor of stability to the portfolio, even if it means giving up some of the potential upside from riskier stuff. And geographically, we see a pretty similar story playing out. They're dialing back their exposure in places like the Asia-Pacific region and rotating that capital into other parts of the world. And here is where it gets really nuanced. Yes, they did increase their U.S. exposure by 5%, which was a great call in hindsight. But, and this is the critical part, they didn't go all in. They didn't concentrate their bet enough to capture the entire meteoric rise of just a handful of tech stocks. This disciplined diversification is precisely what caused that short-term underperformance. This prudence isn't just about one year's numbers. It's about building a portfolio that can handle whatever future shocks are coming its way. They actually game out worst-case scenarios to make sure the fund stays resilient for decades. For example, they run these intense stress tests. If a global financial crisis like 2008 happened again tomorrow, they figure the fund would lose about 11%. Now, that's a big number, for sure, but it shows they are prepared for and can weather that kind of catastrophic event. So what about a different kind of shock, like the rapid interest rate hikes we saw back in 2022? Yep, they model that too. The estimated loss is about 8%. This kind of rigorous what-if planning is what a long-term horizon is all about. And this long-term thinking even applies to massive global trends, like climate change. Instead of just selling off all their oil and gas stocks like some funds do, they take what they call a whole economy transition approach. They stay invested so they can use their influence to help these companies decarbonize, believing that's a more effective and probably more profitable long-term strategy. So let's bring it all home. What's the final verdict on this performance puzzle? Well, it really all comes down to the time frame you're using to look at it. And here you have it, the two stories side by side. The short-term story is about underperformance, all because they chose not to chase a very narrow, very hot rally. But the long-term story? That's about discipline, diversification, and building a resilient fund that's designed to last for generations. They are two sides of the exact same coin. And you don't just have to take my word for it. When you zoom out, independent analysis confirms their long-term strategy is absolutely working. On a 10-year basis, they rank second in the entire world among national pension funds. They also get top marks for governance and transparency. This right here is the payoff for that marathon runner mindset. Which leaves us with one final big question. In a world that seems to get more volatile and more unpredictable every single year, is this kind of steady, disciplined patience the most powerful investment strategy of all? The CPPIB is betting $714 billion that it is.